Erin, how do you position yourself in this kind of environment? Jim Mellon is actually just long gold because he thinks there will be a correction in U.S. equities by around 20 to 25% in the next 2 years.
Right. So we actually continue to believe that the global cyclical story is still quite supportive for equities. And so we are not concerned right now about a very large correction. Certainly, we've seen, the equity market consolidate somewhat. And we do think that the market really is in a little bit of a consolidation phase still. But we do think that the back half of 2018 does look much brighter. And we do think that the corporate earnings recovery story is still very much intact to support an upward bias towards equity markets throughout the duration of this year. That said, certainly we are in an environment coming into 2018 with higher volatility, and we do think that that higher volatility is likely to persist. So that does, I think, put downward pressure on equity multiples. We've seen that happen to date over the last couple of months, and that is not something that we think is going away. The way to position this, though, we think is being appropriately hedged. Some of the ways that we really like hedging right now is being long the Japanese yen, which we think is a great diversifier of risk, particularly in risk-off periods. We also think, along the same sort of line of thinking, that being long treasuries, at least in the short term, can also diversify risk pretty substantially, particularly when you're looking at multi-asset portfolios. So still, the stock-bond correlation is still in negative territory, and I think that's likely to continue to remain in place, at least for the next year or two. And as a result of that, I think that being long bonds against being long equities as well still offers an appropriate way to be sort of hedged in a multi-asset portfolio construct.
Okay, Erin, do you buy currencies? Is there a hedge with yen, or is it the wrong currency to buy at the moment, or do you just hedge buying volatility?
So we like being hedged by being long yen, particularly against some of the other sort of currencies like Aussie dollar, which would be, I think, caught up in the crosshairs, particularly if Section 301 tariffs are implemented. It's not our base case, but we do think it's a really good hedge, being long yen, being short Aussie dollar. With respect to the dollar, we still think the dollar is in a weakening mode throughout, and it's really structurally overweight still. So we think that the dollar will continue to weaken. And what's interesting, actually, is if you look at past parallels in terms of trade wars, typically, although the short-term impact to the dollar could be seen as, dollar bias higher when the U.S. engages in trade wars, over the longer to medium-term picture, the dollar actually weakens because while certainly you see a short-term increase in terms of inflation, the long-term implications for growth are quite negative. So we do think that if a trade war really were to escalate, the dollar would actually weaken in that environment. So as a result, we actually continue to remain underweight the dollar, in part for that reason, but also in part for structural reasons as well.